Hey everybody, Rasul CRE back at you again with another video. This time I'm going to be doing a presentation on my latest deal. It's 104 units in the San Antonio MSA. Super excited about it because it's a 506B, so a lot of my non-accredited investors can get involved in a deal like this. You don't need a net worth of $1 million or more. You don't need to make even $300,000 a year to be able to be involved in this deal. So all you got to do is be a sophisticated enough investor. You understand the presentation and everything like that. Obviously, we can have conversations about it. And without further ado, I will jump right in and go ahead and share my screen. Swap these two because they always switch for some reason. All right. So if you guys have any questions, save it to the end. I'll go through the presentation. It's going to be pretty straightforward, and I will get to everything that you guys want to know about it, or, leave some questions in the chat, and I'll go ahead there as well. So this is going to be the Nest Apartments. It's in San Marcos, Texas, which is located between San Antonio and Austin, which are two fast, rapidly growing markets in Texas. And of course, every time I do one of these, have to have the general disclaimer. You guys can read that on your own time. This is not financial advice or anything like that. I'm just presenting the opportunity, you guys. Make sure you do your due diligence and all that good stuff. So these are a couple of the photos. As you can see, it's actually been kept up really, really well. I remember when Chris Miller had brought this deal to me initially, we were just having a conversation. I think it was just about what it was that he was doing. And he told me he was working on this deal a couple months ago. And I was like, man, I really want to be a part of this deal. Like, then let me know if you ever need any help. And lo and behold, he hits me up actually just this week and said, hey, man, if you can help out with a couple parts of the deal, we'd love to have you on the team. And I'm like, absolutely. So here I am doing my part and all that good stuff. So some of the highlights, excellent location. Like I said, it's along the I-35 corridor. That is like a north-south highway that runs between San Antonio and Austin. Excellent visibility and frontage road access, like lots and lots of drivers. That's really important. A lot of people don't think about how many drivers pass because it's kind of like free marketing when people can see you from the highway or from the road or anything like that. Recent renovations, the current owner has actually put almost $1 million in capital improvements, which is money that we don't have to spend as investors. We pay a little bit of a premium for it, but it's kind of like a give and take, right? In this market, it's actually better that these guys are already putting that money in there for us, so we have just a little bit less to put in there. And my favorite part about this whole entire deal is the unit mix. 90%, like over 90% actually, are over 2 bedrooms or bigger. So, when you guys hear me talking about multifamily, when you talk about the unit mix, maximum for me, I want maybe 33% 1 bedrooms, and that's it. And this one, there's only 10 1-bedroom units, and 6 of those are 1 beds, 1.5 baths. So it's a little bit of a bigger unit size as well. So this is going to be the executive summary. Again, like I-35, Austin as a market, it's actually kind of like where all the people are leaving California and coming over because they don't like the politics, they don't like what's happening tax-wise, anything like that. They're coming to Texas. Austin is like their #1 place to go to. It's like the fastest growing MSA in the state of Texas. With Disrupt, I actually have 2 deals under contract out there as well, which is like, it just speaks for it because you guys know what I do with Disrupt. Tons and tons of market research and all of that stuff. So Austin is a banger of a market. Very pricey, very hard to get in. San Antonio is kind of like, I kind of look at it as like the Jacksonville of Texas because it's up and coming. A lot of people aren't, it's not as inundated with investor capital and everything like that, like a lot of the other cities are. But San Antonio is up and coming. It's huge, right? And so all of these things, like the growth here and the growth here is pushing towards San Marcos. And it's actually kind of crazy that they had like 49% population growth. The #1 most important thing with multifamily investing is population. If you don't have enough people, more importantly, if you don't have enough people growing in that area, then it's going to be very difficult to lease up. But when you have rapid growth, everybody knows there's a housing shortage right now. So as the people are coming in, we're not able to build the units fast enough, which is always making these types of investment vehicles really, really attractive. So these are some of the quick overview. 7% preferred returns. So you're making 7% of your cash on a deal like this. Projected AAR is 18%. The investment terms for 5 years, although we would ideally like to exit sooner, like immediately as soon as our CapEx plan is finished. If the market is okay with it, right? Interest rates are favorable and we can get out and sell it to a prospective buyer after completing it, we can hit our targets of 1.9, almost 2 equity multiple in that time frame. Just holding it for that extra time is, icing on the cake for us. And it's going to be a 70-30 split, meaning that 70% of the proceeds after the preferred is paid is going to the LPs, and then the remaining 30% is going to be going to the general partners. So here's our sources and uses. We're buying this thing for $12.6 million. Got a couple extra dollars for operational capital, just to make sure that transitional period of takeover is going to be able to be funded, no problem. Capital improvements, our CapEx, $729,000, and closing costs of $1 million, right? So everything added up is 14.7. Those closing costs are a little bit high. Typically, you're looking about 1%, give or take, on one of these deals. This one's like 10% because of the type of loan that it is. We actually got interest only for the entire 5-year period. So that's from an underwriting perspective, that's like a little bit of another give and take, right? You pay a little bit more up front, but now while we're holding for the entire duration of our hold period, we actually have the ability to have higher cash flow throughout the entirety of the project, as opposed to like maybe the first 2 or 3 years of interest only period. And then you have to start paying principal after that. We have it for the entire 5-year duration, which is actually the first time I've seen a 5-year interest only on a deal. So projected returns, for example, if you had to put in $100,000 into the deal, you're making your 7% preferred return. So you're making $7,000 on that for the whole entire time. And again, there are contingencies if the market calls for it. Either sell around year 2 to 3 when we're done with our capital improvement plan, or we can do a refinance if it's financially more viable, right? We anticipate a midterm hold of 2 to 5 years, just like they said, right? So the business plan, right? For the first 12 months, we're going to be doing the exterior. So ideally, what we want to do is make the outside more attractive to start bringing more prospective tenants in. Because right now, the rents are about maybe $150, almost $200 below market at the moment. So having that nice, new crisp look on the outside is going to start bringing in new tenant bases, right? And then after that time period, we're going to focus on the interior as people start, moving out. They end their lease, they want to move, or whatever it might be. We'll renovate them as their lease comes up, or if they want to take one of the renovated units, they can switch their lease out. Either way, however it works, we just try to shift everybody around, and it's going to take, at least 12 months, maybe, 18 to 24 is what I've seen in most of my deals around this size to maybe get that going on. And so obviously at this point, we'll be looking to test the higher upgraded units. You're going to see how far you can push it. You want to see if you can stress test and get things where you want to go. And some of these markets, man, I've seen, we've gotten well over $500 in lease trade outs, and that's in Florida in one of my deals. But Texas, again, is, between Texas and Florida, I mean, it seems like the 2 fastest growing states in the Southeast. It's pretty amazing what's happening out there. Unit renovation. So this is how we're planning on doing some of these unit turns. Updated fixtures, make more modern lights, new cabinets. All this stuff is pretty standard. Black stainless steel appliances, much better. Get rid of some of the units that have like the the classic look, the white stuff. They don't have like the nicer floors, farmhouse sinks, and resurfaced countertops as well. Right. For the exterior upgrades, definitely putting in upgrading some of the playgrounds, everything like that. Preferred parking is something that I've seen as a business plan for a lot of places. Parking is at a premium, right? We're always, this type of property specifically has a higher, higher unit count, and the unit mix is more bedrooms, right? So we got 2, 3s. I believe there's actually a 4-unit bedroom here as well, which is pretty rare. And so a lot of times you'll have like roommates and things like that. So parking does come at a premium. It's one of those, minimal cost value add type things. A lot of people have seen if you're paying $25, $50 on a deal like that in a market like this where the cap rate is, that's easily, if you're paying $25, $50 a month extra on top of that, that's a valuation boost of, I think, like $500,000 to $1 million just in that alone. So obviously make the parking lots look nicer, restriping, doing the roofing, siding repairs, exterior paint, definitely change the color scheme to be more in line with our brand and everything like that. So other revenue streams, the amenity fees for like the package locker, that's also something that I've seen, especially in Florida deals that I've got. The pet audits get a whole bunch of pets on there and they're not even collecting on them. So that's going to be like, free NOI boost right there in the other income. And then RUBS, ratio utility billing, bill back. You can, charge the tenants for their proportional use of like water, electricity, things like that. So, and we also have trash app fees. So these things are going to help boost the overall NOI pretty significantly as well. So this is a list, and I'll give everybody a copy of this presentation so they can go and see everything as well. But this is basically a breakdown of the renovations, how much it's going to cost based on our estimates for everything out there. And then this is going to talk a little bit more about San Antonio. I actually went out there last year. I think that was like first time out there. I was stationed in Texas for a little while, but I was pretty far removed from San Antonio specifically. And it was nice to get out there and see the sites and, go visit the Alamo and do all of the stuff. And I passed through San Marcos to get to Austin when I was out that way as well. I think I stopped here for like a burrito or something. Lots of good Tex-Mex out there. So San Marcos, one of the fastest growing cities, not only in Austin, but also in the entire state. And I talked about that. They got really low vacancy rate, right? I mean, there's just not enough housing. That's just what's been going on in the market. Multifamily is, I don't know if you guys think about where you guys live here in South Florida, Miami. I mean, my friends are paying like $2,700 for a 2-bedroom and they're about to go pay $3,200 on their rent renewals. It's just insane, right? Just people are building some new product out there, but it's moving with inflation and everything like that. And it's no different in Texas as well. And since 2010, the city's grown by more than a third, which is, just absurd, population growth. Things like that are real big drivers for multifamily investments and valuations. And it actually further drops the cap rate, even though on the underwriting, we're still projecting, from a conservative standpoint, a higher exit cap, right? So some of the largest economic drivers, Amazon Fulfillment Center, I think they've got a few of these facilities and they're actually building more of them, which is awesome because each one of these things bring in thousands of jobs. Outside of population growth, jobs and job growth and big employers and different, diversification in the market is really what you're wanting to look for, right? You want more employers coming in to, just make it a place where people can not only live there, but make a living there as well. So some of the details of the property, it was built in 1975, garden style. There's 23 buildings and 2 others, comes out to a total of 104 total units. We actually have the swimming pools, a lot of the amenities over here, laundry room, large dog parks already there, right? They're just improving on the things that are already existing, right? And you can see it's like nice quality stuff. It's not like rinky dink. The current owner is, they put some good money into here and it actually really looks really, really good. So the site plan right here, this is I-35, which is huge. So right off the exit of the highway, you have, direct access and visibility over here. So Social Security Administration over there, that building on a GSA contract, like all other buildings. So there's good employers over there. And there's a good, this picture right here. So right off the highway, you can get into all the major stuff that everyone's getting. So like there's universities, pod storage, like all the typical, wherever you want to live, you have your Chili's, Red Lobsters, those Darden restaurants, the Amazon Fulfillment Centers just up the road. All the stuff is right off the highway, right up the street from where this property is located. And then from this other angle, you'll see that next apartment's over here. On the other side, you got a lot of the retail shops and everything like that. Sports center over here, and another like, hey, Kobe Steakhouse, and just nicer restaurants. And then there's also a university as well. So again, a breakdown of the unit mix and the current rents. Right now, it's renting about $1.42 per square foot. That would be 1,081 average rents right now. And the different floor plans, even the one bedrooms have 700 square foot, one and one half bath are the 740. The Cardinal 2-bedroom 1-bath is 760, and the 2 1.5 bath 740. So these are actually pretty big unit sizes for the area, especially considering the 1 bedroom and the 2 bedrooms. And so if we look at the comps on the 1 bedrooms, so these are the different properties out here, all built 1970s vintage, similar unit size in the unit count. I know we only have a couple of these, so it's not that much, but you can see that we're right over here at 961, and there's a couple other ones that are even higher. This one's 760 at 480 square feet, right? These are the kinds of things that I look for. So you can tell by the rent per square foot that 137, we're relatively low on the list. There's some room to move up on that, and all this is less than 2 miles away. And then on the 2-bedroom rent comps, we're at $1.37, $1.44 for these 2 bedrooms, and there's we've got 92 of these 2-bedroom styles. So this is where most of our value add is really going to be coming in. So being able to have it bump from $1.40 up to possibly $1.50 and then $1.57 somewhere is going to give us a little bit more room to be able to push and increase the value on there. And then we have the 3 and the 4 bedrooms. Only a couple of these. These are very interesting. 1,500 square feet on the 3-bedroom and 2,000 square foot on the 4-bedroom. Like, that's huge. That's a house. It's actually bigger than my parents' house, I think. Some of the financials. So a quick overview in year 1, year 2, year 3 through 5. We're looking at the first year, 5% rent growth, and then tapering off to like the conservative 3% year every year after that. And then having a bigger loss to lease up front because we're doing those renovations and everything like that. While people are going to be, while we're doing those renovations, obviously those units are going to be just vacant for a longer period of time that we want to. We account for that in the underwriting with the higher loss to lease, collection loss, and things like that. There's bad debt. And then you can see over time, our other income is going to be like getting boosted and going up and above. And that's where we're getting a real, a bigger portion of what we could increase that NOI and that bottom line for. And you'll see starting off, we're about 49% in the expense ratio, and that's going to be tapering off as well. I think we have even 3% escalators on the expense ratio too. Oops. And then our NOI starting out from 772,000 going up to almost $1 million by the time we hit year 5 on that projected growth. So these are a lot of notes about the pro forma assumptions, basically saying this is how we got to those numbers. Again, this is a lot of reading. I don't want to read the slide to you guys, but you guys will have a copy of this, and you can read that at your leisure as well. But this is basically how we calculate every single line item over here. So some of the questions that a lot of people have, what are investor requirements? Again, this is a 506B, open to accredited and up to 35 non-accredited investors, right? Once we hit that number, I doubt we're going to get to that number because the minimum investments are 50,000 and the maximum is 500,000 because we don't want people owning so much that they actually have to become general partners at that point. Can you invest money from your IRA? Absolutely. You can roll cash over from solo 401ks and also your IRAs as well. We were set to close in late April. We took the extension. We're actually closing on this one within the first couple of weeks of May. So there's a shorter timeline on this than I'm normally used to. But I mean, yeah, with a deal that's, in a hot market like this, it's not going to be that difficult to be able to make it happen. So profits are distributed, 7% preferred return plus 70% of the proceeds afterwards. And then due diligence has been done for a couple of months now. So a little bit about the sponsors. Chris Miller is the one who brought me in the deal. Also, another warrior. Got plenty of my warrior folks on the call right now. And Chase Craig as well, both of them Smart Wealth Equity. I don't know if you guys have ever taken the time to talk to Chris or Chase, but they are very, very sharp individuals. When I went out to Texas and San Antonio, he gave me some good recommendations of places to go, some properties to go visit and everything like that, but he wasn't in town, so I couldn't actually meet him face to face. I did get to meet him in Sarasota, though, at one of the Warrior events, so that was pretty cool. And then the rest of the team, Tom, Patricia, everybody knows Tom, right? My Warrior friends. And these guys, capital partners, Ben and Tim, and then Devin Elder, Roberto Bernal. And then also this guy, Rasul, is actually on a pitch deck for the first time. Like, I'm always like an afterthought coming into these deals, but I'm glad that these guys took the time to bring me on there. But yeah, that's basically the long and short of it. Yeah, usually about 30 minutes to go over these deals. But you can subscribe to our investment portal. That's the Smart Wealth Equity, guys. I got to take that one out and put mine in there. I'll send my my investor portal link in there as well, so you guys can have a copy of that. But yeah, any questions?